Huge things are now happening around Fitbit. First off, read this disclaimer carefully. This is the company in question. They probably do not need a whole lot of introduction. They make really good smart watches. Arguably leading the wearable revolution. I have a Fitbit Versa myself and I am very happy with the product. There are two primary news that have a lot of potential. One thing is Google buying Fitbit. It is expected to be done this year, but there is some scrutiny here before the deal. But it certainly seems like the deal will come through. Google is certainly very interested. But the other thing that could be really huge given the recent health situation we've had around the world, that is research into how Fitbit could help detect the flu, because there is a relationship between heart rate and the flu, and there are many other variables that it could take into account, like if there is a change in your temperature and you move less. That could, those kind of data could be combined to give an indication of your health. And this, of course, could be really huge for Fitbit. Let's jump into the charts, because something interesting is happening. That is why I made the video now. Okay, so since the IPO, Fitbit, it crashed completely. There's no doubt about that. However, there's a big but here. Fitbit is in a completely different category, wearable intelligent watches. When you do something that disruptive, it will be very difficult for the market to price your company. And if you look at the fall from the all-time high to the all-time low, that's minus 94%. I mean, that's a pretty sizable plunge, and no doubt about that. Hence, Wall Street was pessimistic about Fitbit. But here is a change in the sentiment. Here you have the stock more or less unraveling. But when is this? This is actually August 2019. That's when the low was made. And since that we have had a very violent rally. 137%. That's of course very impressive. And this is also a great lesson, because it goes to show you that after there are these huge rips, you very often see some pullback, which we see here. We have a rounding bottoming formation, and now finally after all this work, relaxing, cooling down, we have pushed above the 200-week moving average, simultaneously as we have held the 5-week moving average, which it's a very interesting combination of events here. And there certainly seems like there is some strength here to Fitbit. From a long-term perspective, it's a very interesting opportunity. You have the combination of events. You have, Google, and Google have a lot of data. There's a lot of things Google could do with Fitbit. That's obviously got tremendous potential. And when it comes to health, let's remember that Google played a very key role now during the health situation. And I can guarantee you, Google would definitively capitalize on that and could make Fitbit a huge name in the wearable tech space. I mean, it is a big name now, but it could be pushed to the point where doctors would specifically recommend you to buy a Fitbit. Not simply to potentially detect the flu, but it measures all kinds of other things as well. The accumulation distribution line is corroborating the rally. You can see here that It is at the highest it's been in a long while. The statistical correlation between the S&P 500 and Fitbit is 3%, so basically negligible. Looking here at the daily data points, here you can see the massive rip, huge rip, cooling down, and this looks very constructive. A very nice formation. In many cases, these formations, they work out very well for the bulls. Obviously, there's no guarantee. This thing, though, is that you kind of need to view charting as a psychological study of the markets, because here you have battle between bulls and bears. Here you have the bulls starting to gain control and build momentum consistently. And during the pullback here, we did find support at the 20-day moving average. And it's held up relatively well also during the health situation we've had globally. Part of the reason is that Fitbit can be a very key actor in the health space. RSI is looking good, and let's now continue. We will now look at the fundamentals, and then we will have a short segment about deflation, which is a very important concept in economy. Okay, so here is Yahoo Finance. Fitbit, the market cap is $1.8 billion US. Beta is in line with the market. It's considered to be overvalued at this point. Analyst recommendations are 3. The price targets are very interesting. Very interesting, okay. So here are the analyst price targets. So Fitbit is currently traded at 687. Let's calculate that. 687, and the average analyst price target is 735. Okay, so let's do the math. Okay, a bit tricky to do in the head, but yeah, like that. From there to here is a rally of 7%. If we go here to Saks, they have a number 3 hold as well. Basically, you have most analysts just sitting there in the neutral camp. See value score, that is not too shabby for a technology company. C growth and A momentum. The category here is bottom 47%, measuring instruments, electronics. I don't agree with the industry rank. I think you need to put Fitbit in a completely unique category of wearable tech. No dividend, but that's not any surprise. If we go here to Teletrader, you can see that year to date, Fitbit is up 5%. Okay, so it is in the green, but nothing more. I have categorized Fitbit here in the Zeitgeist category. I have a category that I call portable technology. So if we go here you can see various portable technology stocks. You can see the distance from the 52-week low. The Fitbit, it is up a whopping 145%, so that's a big move. Relatively close to the 52-week high. I mean, if you look at the world stock market, it is minus 18% away from the 52-week high. So, it's certainly outperforming in that regard. One of the main competitors for Fitbit is Garmin. Apple, they also have wearable watches, but Apple is definitively not a pure play wearable tech stock. Okay, so let's now jump into the segment about deflation. Deflation, okay, that is when prices of products and services decline. One of the big points many have made, which is a very interesting point, is that technology is inherently deflationary. That's the trend. You see that if you look at the cost of, one gigabyte SSD now compared to, the first ones, I mean, the price has just gone down dramatically. Look at, flat screen TVs, graphic cards, smartphones, you name it. I mean, it is extremely deflationary. Okay, so deflation, the inflation rate is below 0%. So that is, the textbook criteria for having deflation. Inflation rate below 0%. Purchasing power of savings, wages, and tangible assets increases during deflation. Deflation means money supply is shrinking. And it is common during deep recessions. But there's also, many recessions where you've had extreme inflation. Inflation and deflation are very, it actually is a very complicated mechanisms that a lot of energy is put into managing these powers because they have huge impacts on everything in the economy. This inflation is positive but falling inflation rates. Things contributing to deflation, that's people reducing their debts, stricter lending practices, higher taxes. Consequences of deflation, decreasing prices makes consumers wait. Yeah, because because the value of your money is actually increasing. Wages decrease and unemployment increase. That's one consequence. Investors flock into cash. Yes. Export business benefits from deflation. And central banks, they certainly fear deflation. Let's quickly take the pulse of the market, the stock market, reflected with the S&P 500. Daily data points. Okay, so we did have some relatively impressive gains yesterday, some big moves, but then towards the end of the day, the investors they just run out of fuel. You can see it here. Okay, big rally, and then it's like, okay, this is when you are heading towards the close of the market, and the investors were lacking faith. And I think that's the big danger of this market. This is why I say that this market is broken. It's a broken market. You have bulls that are terrified. You have bears that are also terrified. So you have a lot of people who are just really like, okay, I wanna take profit when I can. And that could lead to a very damaged market. The interesting thing about this rally here after this major crash, is that there is a concept in investing that's called the greater fool theory. Okay, so because when you are buying stocks in order to sell it to someone else, okay? You want the price to go up. And the idea is that during closer to the lows, that's when you find the most sophisticated and intelligent investors. While closer to the ultimate, the recent highs, this is when the money is becoming less and less sophisticated, meaning you have the greater fool. And so one of the greatest fools you could have in this market, arguably, is not necessarily the retail trader, which gets a lot of critique by Wall Street that is not able to beat the S&P 500. That's very ironic. So whenever you hear podcasts talking about, oh, look at what the retail traders did, and the same people that will never beat the S&P 500, okay, that's something to think about. But the greatest fool, coming back to that, the greatest fool in this market, that could actually be the bears wanting to fight the Fed. Because you had many bears who were short the market. I was an enormous bear myself, and I was bearish in various instances. But when I heard about the Fed pouring trillions into the economy, I knew that you have to be very careful. You need to have some very clear signs before you go short. And throughout this rally, you had many big bears who were shorting the market, who were effectively the greater fools. They were fighting the Fed with who had trillions of dollars at their disposal, that they could use. I mean, there is a saying that you should not bring a knife to a gunfight, and you should not use your, $1 million account to fight someone who can throw around trillions. However, if there is a greater fool system in place here, it means that we are running out of buyers. Many of the bears who were short have now covered their shorts. They have thrown in the towel, meaning if we are now completely running out of buyers, all the greater fools have either gotten into the market or have folded their short positions. That means potentially the only way we can go is down. Okay, that's one bearish hypothesis I have. I'm not saying that it's going to happen with the S&P 500. Very dangerous to fight the Fed. But that is a potential side effect of what the Fed has done. It could be a scenario. You have a support here at the 20-day moving average. As long as that support holds, the bears should be very careful about anything. We do have the 200-day moving average here and the 100-day. Both are negative, and price will eventually come into contact with them. That's when the bears have the biggest opportunity, in my opinion. If they form a very solid rejection of those levels, then you could get a self-accelerating sell-off. Okay, whatever you do, of course, you want to let the trend be your friend, and have a fantastic day, and think a bit about Fitbit.